So now we're going to do an overview of all of asset pricing theory. I'm going to do in this lecture pretty much a preview of where we're going with everything to get the big ideas together, and then we'll circle back and do everything in more detail. And now the preview of the preview. So what's asset pricing theory about anyway? Our big question is, what is something worth? Assets are anything that promises you a stream of future cash flows. Think of a stock, a bond, a piece of real estate, a real investment like building a factory. All of those things have in common, you put in some money now and some money comes back later on. You don't know quite when you're going to get it and you don't know quite how much you're going to be. So our question is, when you're promised a stream of cash flows, what's that stream of cash flows worth? That's why we call it asset pricing. Now this would be easy except for time and risk. The stream of cash flows, who knows when you're going to get it and who knows how much you're going to actually get. So accounting for time and risk is what everything in our theory is about. Once you can have a formula for what's something worth, that can also be useful for calculating derivatives. How much would the value change if something happened in the world? If oil prices go up, how does my portfolio get affected? If interest rates goes up, does my bank blow up? Risk management, the art of risk management is guessing how things will change if things in the environment change. And once you have the value itself, you can calculate derivatives and do risk management. Our approach is going to be actually very simple in terms of economics. If you remember from microeconomics, this graph, apples versus oranges, a budget constraint, an indifference curve, that's just what we're going to do. We're going to look at prices relative to people's preferences. So that picture can lie with you even when the equations get a little bit complicated. I want to emphasize our approach is the equilibrium approach. We're not looking for great investment opportunities. Well, we are. But first, we're going to see to what extent can we explain existing prices as equilibrium compensations for risk. This can be useful even if you want to go invest. At least you want to know if what's out there is a compensation for risk. And then if the prices don't obey that, then you might have found something that you could buy and make money at. So our question is, what will the market look like after everybody's invested, after they've done the best they can, after prices reflect the equilibrium compensations for risk, which is at least an important baseline. Now, where are we going to go? Our goal for the rest of today is to derive the basic asset pricing formula. So the way our theory works is this formula. Price is expected discounted by marginal utility payoff. That's it. I often write this in simplified form, MP equals E of mx, where m stands for all that stuff. And once you've done this 20 times, you'll know where to put the t's and the t plus 1s. So that won't be a big stumbling block. So our goal is first, understand this basic asset pricing formula. And then over 6 weeks, everything in finance, all the theory of finance derives from that basic formula. So today, we'll understand the basic formula and then see an overview of how all the classic issues of finance drop out of that basic formula. I hope you're excited to see how it works. So our objective is to get to the basic formula from which all asset pricing follows, P equals E of mx. What does all this stuff mean? Any formula, the way you get to it is first understand the players and how it works, and then do the derivation. So let's understand what X is. X is a way of encompassing the payoff, that's the name of it, payoff of any asset. So for example, if I have a stock, I pay a price P for it. And what I get tomorrow, the payoff, is tomorrow's price plus tomorrow's dividends. If I buy it for a price P, that's the amount of money I could sell it for tomorrow and be done. If I buy a bond, I could pay a price P, which might be like 98 cents, and get $1 for sure. Or I can invest $1 and get the risk-free rate. That might be 1.03. So bonds also have a payoff, just like stocks. The prices can be zero. A classic example is a bet. If I bet, if you bet against your buddies on the next football game, you put down zero money today and either gain $1 or lose $1, according to whether your team wins or loses. All of those can be encompassed into price today and payoff tomorrow. The payoff is random. You don't know what's going to happen. It's a random variable. So the way to think about random variables is there's multiple states of nature, which will denote S, each of which has a probability associated with it. And here's the list of the things that could come out. I just did a simple example. The payoff could be 3, 1.5, 0, or -5 with associated probabilities. Of course, we will usually think of probabilities as being continuous. We'll draw something like a distribution of possible values for x along with a probability distribution. But you need to keep in mind that x is potentially a random variable. So we have random payoffs. Now the big question, what's it worth? Once we understand the possibilities for the payoff, what is the investor willing to pay to get that random payoff? Now, there is nothing written in stone about asset pricing. Asset pricing is modeling human behavior. We need to write down a simplified model of how people feel about stuff. There's no way avoiding psychology. Martians might feel about stuff differently than people feel about stuff. And that's the point of the utility function. The utility function is a way of, in a very simple, consistent way, capturing the evident fact that people prefer money now, and people prefer money that isn't so risky. And so what we need is a mathematical structure to help us capture those features of human psychology. And that's what the utility function does. It answers the question, value to who? So the way we write down the utility function, the utility is defined over consumption today and consumption tomorrow, CT and CT plus 1. And the form that we'll use almost to start with, we can do fancier utility functions. Today we're doing the very simple version to understand how everything works. It'll be the utility of consumption today plus beta, a discount factor. That's a number typically on the order of 0.95 at an annual basis, just a number, times the expected utility of consumption tomorrow. Now, what does the internal utility function look like? We want to capture the fact that people like to eat more, but once you've had your third pizza, the next slice of pizza doesn't feel quite so good as the last ones. So the utility function maps consumption into happiness, and it rises, saying more is always better, but it rises at a declining rate, saying once you've had a lot, extra consumption isn't that valuable to you. So a typical functional form that we'll use, we have to work out problems. We have to be able to create little artificial economies and see how they price assets. A typical functional form we'll use, because it's very convenient, is this power function, c to the 1 minus gamma. You can see that the 1 minus gamma over here is there so that marginal utility is simple. Marginal utility, which is what's going to show up in all our formulas, is just a power function. Or as gamma goes to 1, the simplest and clearest of all, the log utility function. That's a function that looks just like this. As consumption goes up, the log utility function goes up, but at a declining rate. As consumption goes down to 0, people get really, really hungry. And in fact, the marginal utility is the most important part of asset pricing. What matters for asset pricing is not so much the level of utility, but the marginal utility, how hungry people are. Marginal utility, the slope of the utility function declines. That's how much a little extra consumption would make you happier, and it rises as consumption goes down towards 0. So that's our utility function. Now, what does the concavity of the utility function by us? Let me remind you of the classic illustration of risk aversion. So here's a concave utility function. I've mapped in the blue line how our investor might feel about a little bit of consumption C bar. If you've got consumption C bar, you look up at the utility function. That tells you how happy that consumer is about consuming C bar. So that's a measure of the consumer's happiness. There's a little smiley face. Now let's ask that consumer, how do you feel about taking a bet where you might gain delta or lose delta? So his two opportunities are either gain or lose the same amount with equal probability. Let's bet on that football game. Well, if you gain, here's the new utility, and there's the new utility. If you lose, there's the new utility over here. And you can see that because the utility function is concave, therefore the expected utility is less than the utility of the original value. This consumer is made less well off. His utility goes down if he's forced to take a bet. Fundamentally, why is that? That is because people dislike losses more than they value gains. We're capturing that feature of human psychology that people feel losses more acutely than they like gains, which is related to the same idea that after you've had a whole lot, an extra doesn't help a lot. Once you have very little, people who have very little are hungrier. So now we've got a gorgeous mathematical form that lets us separate the two crucial items we're looking at. The discount factor tells us how much people dislike delay. If we raise that number from 0.95 to a higher number, we say that, look, stuff that happens in the future is less valuable. As we raise the curvature of the utility function, as we make this gamma number larger, the gamma number larger makes the utility function more curved. That's going to make people more risk averse. So we have a simple mathematical formalism that lets us say, what's the value of the payoff to who? To someone who likes things now, measured by beta, and to someone who is averse to risks, measured by curvature of the utility function, or gamma, in this simple functional form, which we will, of course, generalize as things go on. So now step 3. Our objective is to understand price equals expected discounted payoff. We've discussed what a payoff is, a random payoff. We've discussed to whom, who is going to assess that value, somebody with this utility function. So now let's ask somebody with that utility function, how much value do they give to a payoff? And that's so easy we can do it in 3 lines. We want to ask our investor, look, do a maximization problem. Choose, start at your initial consumption, pay some today, lose the price today of the security, but in exchange, you get a little bit more of the payoff tomorrow. Tell us, go invest optimally. Go buy securities until the marginal cost of losing that consumption today equals the marginal benefit of eating the payoff tomorrow. So you know how to take that derivative, and the first order condition is right here. Price times marginal utility of consumption equals beta times expected marginal utility of tomorrow's payoff, or simply rearranging, we put the u prime of c down on the bottom. We can now say that today's price is the expected discounted by marginal utility payoff tomorrow. In the power utility case, that looks like consumption growth to the minus gamma power. That is the form of the discount factor for that simple utility function. So look what we've done. In a few minutes flat, we have derived the basic formula of asset pricing. We know how to say, given a payoff, given an investor with discount factor beta and risk aversion gamma, looking at that investor's consumption, we know how much that investor values the asset. Now, some words of intuition. This is, of course, a very subtle formula, and we'll spend a lot of time thinking about exactly how it works. This comes after investment. This characterizes how the consumer or investor feels about value after he's done all the investment sigma that he can. So it's not about how do you value things before you get to invest. The chicken and the egg question from this perspective is the investor looks at the payoffs and looks at the prices, and then the investor adjusts his consumption until his consumption lines up with the payoffs and the prices. We'll think about equilibrium a little more in the future, but that is the thing that adjusts right now until price equals expected discounted payoff after the investor has done all his investment. If the investor looks at this equation and the price looks too low, the investor buys a bunch of it. But when the investor buys a bunch of it, then it's going to lower today's consumption. It's going to raise future consumption until that comes back in line. Second, this is all about marginal investments. At the end, the investor's thinking about, let's just put $1 more in and $1 more out. If you have to invest in a big amount, you're told, oh, you can put 10 million in some venture capital deal or zero, that formula doesn't hold, and we have to think about things more generally. Let's think about what it's saying, the big intuition of the formula. It shouldn't look that surprising in the end for the question we set up. We wanted to know, given a random payoff, what's its value today? You might have guessed, well, given a random payoff, the value today is just the expected value of the payoff. But then that's not quite right because the payoff's risky and it comes tomorrow. So you might say, and people did, well, let's take today's value is the expected value of the payoff, but we'll discount it. We'll say expected value of the payoff, but we'll take an expected return in, then 1 over the expected return might be a number like 0.9. So tomorrow's expected payoff is discounted to today's price. Well, that's not really quite right either. What our formula does is it puts in the M, which is random. We don't know what consumption is going to be tomorrow, but it acts like a discount factor. And that's why we call it the stochastic discount factor. It works in the same way. It's a natural generalization. It makes these ideas more precise. It tells you take the random payoffs, multiply each one by this discount factor, and add them up. And that is the correct way to think about the value of this payoff to that investor. To be super clear about it, how might you do it? You might take my example, payoffs, 3, 1.5, 0, and minus 0.5, each with an associated probability. You don't just take the average. The right answer is you multiply the probabilities times the discount factor, times the marginal utility ratio, and then add them up, and that gives you the value today. Our next job is to take this basic formula, really deeply understand it, and then see how it gets re-expressed in all the classic ideas of the theory of finance.
Okay, so we know the price. Okay, so can you think about that's the price P. Okay, here ST. Okay, so we know ST over 1 plus R, right? And how we can decide determine the R? So by one factor model cap M, or okay, 3-factor model. Okay, 3 factors model. So Pharma French. So the SMB, beta, SMB, HML. Okay. So the R, we can use the cap M, the traditional cap M, or 3 factors model proposed by Pharma French at 1993, or so the factors beta, SMB, and HML. Okay, so you can use that to decide, determine the R. Okay, so the R, so if the R is random or stochastic, so you can use the it's the potential. Okay, it's potential. Okay, so this one. Here is the MT. Okay, MT stands for discount rate, discounted. Okay, discounted by MT. Okay, so it is the stochastic oriented ST. Yeah. All right, and you derive the MT from the consumption. Okay, so you use the intertemporal budget constraint and derive the MT, and the NT can express by the MRS. Okay, MRS we know the marginal. Okay, marginal rate or rate of substitution. Okay. Definitely you prompt CT plus 1 over you prompt CT. Okay, the beta here. Okay, so you can use that. All right, so here is PT, okay, T plus 1. Okay. Okay, for hopefully you can understand.
Welcome. Let me give you a little overview of what we're going to try to accomplish in this section here. Where we've gotten so far is our central organizing concept, price equals expected discounted payoff. We got there by thinking about payoffs, a random thing that might happen tomorrow, say, $1, $2, or $3 with associated probabilities. We thought about an investor with a utility function, and we realized that investor would value this payoff by our grand formula, price equals expected discounted payoff. That's the general version of it. As a warning, I sometimes leave the T's off when you're supposed to know where they go. We looked at that in terms of utility functions. So the discount factor was this ratio of marginal utilities. And we used an example power utility, which we'll keep using throughout. It's not the most general utility function, but it's a very handy one to work things out and see how they work. That's where we got. Our basic concept of valuation here was willingness to pay. We worked out what an investor with this utility function and that consumption would be willing to pay for a marginal little bit of the asset, and that was our concept of valuation. What are we going to do today? We're going to do basically all of the big concepts in the theory of finance that we'll do throughout the course. Today's sort of a preview version of that. First thing we have to do is meet the players: returns, excess returns, present values, and how do you state this in continuous time. It's just restatement of the same ideas with the kinds of concepts like returns that you've seen in our facts day that people in finance use. Thom and French looked at expected returns, for example. We have to think about returns. Then once we've recast these ideas with those players, we'll look through the classic results in the language of finance, if you'd like. We'll look at where interest rates come from. We'll look at risk premiums, and we'll discover that covariance matters. The variance of an asset doesn't matter. It's the covariance that really matters. We'll look at expected return and beta representations, like the Fama-French paper that we looked at previously. We'll learn about the mean variance frontier and all of its magic properties. We'll look at random walks and efficient markets, and that set of thoughts about the time series evolution of asset pricing. And we'll think about general equilibrium. How does this sit as part of a larger economic model? And the question of causality, which is the chicken and which is the egg. Ready to go? Here we go. before we do the classic ideas of the theories of finance, you got to meet the players. We got to think about returns, present values, the other ways of stating the basic representations. So that's what we're going to do now. Alternative representations of our price equals expected discounted payoff ideas, returns, present values, and how does this stuff look in continuous time. So let's start with a return. Rate of return is just a price one security. You put in $1 today and you get back what you get in the future. Therefore, price equals expected discounted payoff just reads 1 equals expected discounted return. So that's the version of our basic formula when the thing we're looking at is a return. Now we thought of this as mx determining p, and now r is in here. And you can think of this one also as determining the rate of return. A low price today is the same thing as a high return from today till tomorrow. It kind of expressing things in terms of returns sort of hides that, but that's what's going on. If you have a security whose price is driven down today, that's the way that it gets a high expected return from today until tomorrow. So this equation is still determining returns in the same way that that equation you can think of as determining the prices. The return concept that we're using here, capital R, is a gross return, price plus dividend over initial price. It's a number like 1.1, not a number like 0.1 or 10% or annualized. People use lots of different units. When you deal with data, make sure that you're using the right set of units. Next, the most common kind of return is the risk-free rate. That's the benchmark that we start at. So what does our basic model say about risk-free rates? Well, 1 equals E of MR. That's what we've gotten to so far. A risk-free rate is risk-free, so it comes out of expectations, and therefore the risk-free rate is 1 over the expected discount factor. So we've got our first case where very clearly you can see discount factors are determining something about returns. And the mean of the discount factor codes the information in an asset pricing model about the level of the risk-free rate. Another way of looking at risk-free rates, instead of you put in $1 and you get like 1.01, that's a 1% risk-free rate, you can think of it as a bond price, and we will do a whole week on bond pricing. A zero coupon bond pays $1 for sure tomorrow, so its payoff is 1, and its price is E of M times 1, or just E of M. So the same idea shows you the mean of the discount factor tells you immediately today's bond price, and the risk-free rate is, of course, 1 over today's bond price. How do we apply the same idea to excess returns? We use excess returns throughout finance. Excess return is the return minus the risk-free rate, or a difference of any two returns. Now, an excess return has a price of 0. You can see this two ways. One is you're differencing those things, so the difference of the prices is 0. Another way of thinking is what is this object? You put no money down today, you borrow $1 and you invest that $1, so no money came out of your pocket, the price is 0. Price being 0 doesn't mean the return is 0, you've entered a bet. A bet is another example of no money changes hands today, but then money changes hands tomorrow. Well, with a price of 0, our basic equation is E of M 0, price 0 equals E of M times RE. Again, it might look confusing if you thought we were determining prices, but no, the price here is given. If the price in some sense falls, that has to change the characteristics of the excess return. It has to promise you more excess returns. Another example, a bet is an example, leverage is an example. In other words, borrowing money to invest. A long short position is an example where you short sell one stock and invest in another stock with no money coming out of pocket today. We look at these a lot because they're very common in the finance world. We look at them a lot also because they help us focus on the question. When you're not putting any money down today, excess returns focus on the risk element. It's all about taking risk. It's not about putting money down today and waiting till tomorrow. So we'll look at a lot of excess returns. Present values. Let's look now at a long-term asset, an asset that pays a stream of dividends. So XT now will represent the dividends paid on each date forevermore in the future. I'm using X, not D. I'd love to use D, but D gets used for derivative. So that's why I'm going to use that notation. But often I and other people will use D. So you got to keep those straight. What does the present value formula look like? Well, the price today is the expected discounted stream of payoffs. Each payoff gets discounted exactly the same way as we've discounted the 1-period payoff. In the case of our power utility function, it's CT plus J over CT to the minus gamma. It's that discount factor applied to the T plus J dividend. Or let's write it in discount factor notation. Now we will have a separate MT2T plus J, a discount factor from time T to time T plus J, which is just the ratio of marginal utilities. This is worth looking at now because this is the one that helps us make that jump to hyperspace, the continuous time. The analog of the present value formula in continuous time you can just write down. Now it's going to be an integral instead of a sum, and an exponential instead of a power. The ratio of marginal utilities is the same, and a flow of dividends. Or in our power utility function, e to the minus delta instead of beta to the j, the ratio of consumption and the flow of dividends. And that lets us define our discount factor. We'll define in continuous time a discount factor, lambda, which is the level of consumption, not the ratio of consumption. So that's what our general formula looks like in continuous time, a ratio of discount factors, which is the ratio of marginal utilities. Now, why does it look a little different? Well, as you saw when we were looking at continuous time likes levels. It likes to look at ZT, the level of the Brownian motion, not epsilon, the differences. So continuous time will define the levels of marginal utility rather than defining right away their differences. So these are clearly related. The multi-period discount factor is the product of intermediate discount factors, and that is the ratio of the continuous time level of marginal utilities. Where did that come from? I just plopped it out, didn't derive it. Well, you can derive it on your own, but the basic idea is pretty simple. Your utility function now extends over the entire future. So the investor now looks over an infinite future discounted, or in integral notation, the investor looks over an entire future geometrically weighted, and I need a dt there. And then with this infinite period utility function, you think about eating a little less today and then consuming the dividends in the future. Next, how are returns and present values related to each other? Well, you can sort of see right away that a return is something like a first difference of the present value relationship. So we have to make that clear. How do you do that? In discrete time, it's pretty easy. The price is the expected discounted payoff. And if you just group all the t plus 1 terms, the price is the expected value of tomorrow's price and tomorrow's dividend. Well, tomorrow's price and dividend divided by today's price is just the rate of return. So what we've done here is from the present value, we've sort of differenced it to get our 1 equals ZMMR relationship. Right? So you can go from present values to return relationship, and backwards, you can accumulate the return relationship to find the present value formula. One's just the difference of the other, one's the integral of the other, with quotes around that difference and integral. Now, how do we do that in continuous time? We need to get to the concept of a return in continuous time, and that's going to be our way of doing it. So what is a return in continuous time? Well, I'll use the notation DRT for a return. That is the change in price plus the dividend paid divided by the initial price. As we let the delta shrink, DRT becomes the growth in price plus the dividend payout. And as you can see, that concept is a little different. It's a net return. It's the growth in price. We've subtracted off the initial price. Well, to go to continuous time, we have to do these of things. And that's why in continuous time, we look at this net return concept rather than a gross return concept. It's also, sometimes it's convenient to keep track of the actual price and dividend and think of the return as the growth in price plus the dividend payout. It's also convenient to define dV over V this way. So V here is a cumulative value process. What that corresponds to, this corresponds to if you bought the stock, you have the price P and you get to eat the dividends X. V corresponds to the idea of put the stock in a fund where all the dividends are continually reinvested, and then V is the price, it's the value of that fund. It's sometimes convenient to look at that way, sometimes convenient to look at that way. Choose whatever's more convenient. So this DR concept will typically also be a diffusion process. It'll have a mean and it'll have a Brownian element. Returns are move around a lot through the dP over P term, which will have a Brownian element. The X typically will not have a Brownian element to it, at least in the simple versions we do. Okay, now what did we do in discrete time? In discrete time, we defined a return. And then we could have found 1 equals E of MR by differencing our present value relationship. That's our key to how do we express P equals E of MX for returns in continuous time. You start with the present value relationship, price is expected discounted payoff. Then let's first difference it. Our first step is we break it up into what happens in the first delta instant and then what happens from delta to infinity. You recognize that as tomorrow's price, right? The delta to infinity, that's just the price tomorrow. So we have price today, we have a little bit of a dividend payment, and we have a price tomorrow. I'll apply the famous ... operator, by which I don't show you all the algebra, and you go read that in the notes. But you take that, and then a couple more steps, you get to our expression for the equivalent of 1 equals E of MR in continuous time. Let's look at what it says. I have 3 different expressions. Some are more convenient than others in different ways. One nice way to write it is that 0 is the expected change in discounted value. You might think that values shouldn't be expected to change, sort of random walk idea. That's almost right. It is the discounted value that should not be expected to change. Another way of writing that is that 0 should be the flow of dividends, which is deterministic, plus the expected discounted change in price. Or I really don't need that lambda v on the bottom. I put it in there, you'll see it's convenient. It can go in and out of the 0 as you'd like. But another way of writing it, the purest analogy to 1 equals E of MR is 0 is expected change in discounted value. We'll make that more intuitive in just a second. Finally, what does the risk-free rate look like in continuous time? Well, a risk-free rate is just a rate of return that doesn't have a dz term in it. You know ahead of time what the rate of return is going to be. So the rate of return is RF times dt. There's no dz term in a risk-free rate. Now, the value of the risk-free rate can change over time. It's not fixed in that sense, but at any instant, how much you're going to get over the next instant is sure, because there's no dz term in the risk-free rate. There's 2 ways of thinking about a risk-free asset in continuous time. One way of thinking at it is a cumulative value process. In other words, you put in $1 initially, and then B is the value in your account. Say you put it in a money market fund and just leave it there. The value in the money market fund grows over time, and the rate it grows deterministically at the risk-free rate. Another way of thinking of a risk-free asset is that the value is always 1, but it pays you a flow of dividends equal to RF dt. So they are actually, the way money market accounts work is the value is always 1, and then they send you a check every month for the amount of the interest rate. Both of those are ways of thinking of the risk-free asset. They both have that property. What have we done? We've taken our basic ideas of price equals expected discounted payoff and re-expressed them in terms of returns, excess returns, present values, and returns and risk-free rates in continuous time. Once you've met those characters and seen how our basic asset pricing formula applies to them, then you're ready to see the classic statements of the theory of finance about how returns, excess returns, discrete time, and continuous time are determined and how they behave. So now that we've met how returns work, we can talk about some of the classic issues and propositions of finance. Let's start with the risk-free rate. Where we got to in thinking about risk-free rates was RF is 1 over E of M. Let's look at that a little more closely. Now, our prime model for M, the discount factor, is 1 over expected beta consumption growth to the minus gamma. And now you kind of have a yuck ahead of you. You're taking the expected value of something raised to a power. It's nonlinear. It's a 1 over. And it would be nice to do some approximations. Here's where continuous time comes to the rescue. And this will be one of your first big payoffs for having invested in continuous time. You'll see how we surmount all these nonlinearities by doing a continuous time approach. So as a reminder, how does continuous time work? Last time we thought about what our basic P equals E of mx looks like in continuous time. 0 equals E of d lambda v. Let's apply that to the case of our risk-free rate. So our basic condition was 0 equals E of d lambda v. I like it in proportional form. Use Ito's lemma. D of lambda times v is d lambda dv, and then the cross term. Don't forget those Ito's lemma cross terms. So that's expanded our basic first order condition for an asset with cumulative value process dv over v. A risk-free rate has a cumulative value process. I call it B because for bond, that's a tradition. It only has an RF dt term, so this Ito term is going to vanish, right? Because if that only has a dt term, that times that is going to be of higher order. So the only terms left now are the d lambda over lambda and the dv over v. Therefore, RF, that term, becomes minus E of d lambda over lambda. You can see clearly how that equation is the continuous time counterpart of that equation, and that you get a minus rather than a 1 over, which is the simplification, kind of simplification that you get out of Ito's lemma and continuous time. Well, that's a little bit of progress. Now let's try to put the consumption back in. So our continuous time discount factor is e to the minus delta consumption to the minus gamma. We use Ito's lemma again. So let's use Ito's lemma to express d lambda over lambda in terms of consumption properties. So what does Ito's lemma give us? We have the derivative with respect to time, the derivative with respect to consumption, and the second derivative with respect to consumption. Don't forget those Ito's lemma terms. That's a general result that'll be useful for us. Now let's look at it a little more. What does this mean? If consumption, for example, follows a diffusion process with a drift and a diffusion, that means that the discount factor has a drift term, which is the delta term. It's the drift term of the consumption that comes out of here. The diffusion term comes out of there, so there's the drift, and then the same sensitivity to the consumption shocks. So now we know how to connect the discount factor to the properties of consumption, and that's, notice it's all linear. That's gotten us around this to the gamma part. Okay, now we plug it all in, and we've got a pretty answer. RF is minus expected discount factor growth. Discount factor growth is this term here. So what do we get? The expected value of that is the drift in consumption. So we just take expected values. The risk-free rate is delta, that's that term, plus gamma expected growth in consumption, minus 1/2 gamma, gamma plus 1 times the variance of consumption growth. That's the continuous time version. Now we can just read from that the discrete time approximation. We've been looking for an approximation to that thing. So in discrete time, the risk-free rate is the delta term, gamma times expected consumption growth, and gamma plus 1 times the variance of consumption growth. Now you've done a lot of work. Let's sit back and enjoy the beauty of what we see. We have here a theory of where interest rates come from. What makes interest rates go up or down? Well, first, delta, impatience. If you live in an economy where people are more impatient, interest rates are going to be higher. Interest rates are about what does it take to get people to save some of their income, not consume it all today, and consume some tomorrow. Well, if people are more impatient, you have to pay them a higher interest rate to consume tomorrow rather than today. Next term, intertemporal substitution. This says that interest rates are higher when consumption growth is higher. Now let's think about that. That seems kind of strange. Here's time. Think about consumption growing at CT to CT plus 1. Why do you have it? If that's a high consumption growth, why are interest rates high? Well, high consumption growth means that consumption is low today. If you knew you were going to be really rich tomorrow, why not go out and have a nice dinner tonight? Well, in order to keep you from consuming all of that stuff today and waiting till tomorrow, we have to pay you a high interest rate to get you to substitute consumption from today until tomorrow. Gamma here acts as the intertemporal substitution elasticity. It controls how much do I have to bribe you with a higher interest rate to get you to consume less today and have a big consumption growth from today till tomorrow. The third term is precautionary savings. If you live in an economy with a lot of volatility, a lot of uncertainty, what happens then? Well, if you live in an economy with a lot of uncertainty, people are nervous about the future and they try to save a lot today. If people are trying to save a lot today, that's going to drive down today's interest rates. We're going to have a very low interest rate because everybody's already trying to save. Here, the gamma is acting as a risk aversion coefficient. It's telling us how much people react to uncertainty about the future by trying to put it all in matrices today. You can see gamma has the same coefficient as having two functions here, and we'll look later in the course at utility functions that separate those two functions and let people have different responses to consumption over time and aversion to risk. Now, this is actually a very sensible theory. Let's think about what it says. This predicts that if there's a time when consumption growth is low, like a recession, like the one we've just been through, then interest rates should be low as well. Interest rates should follow expected consumption growth. You don't need any Federal Reserve. You don't need any surprises like that. This is just how an economy should behave and pretty much how the economy does behave. Variance too. If you go through a period of great uncertainty like the one we've just been through, that predicts that interest rates will be low as well. So this theory it captures the main features of what we see in the data, even though it's very simple. So what have you seen? I hope this is exciting. You've seen the first example of our theory making a prediction about what an asset price should do. That prediction relates interest rates to macroeconomic events and how people feel about those events, and comes out to something that's at least on a verbal level plausibly true about how things work. So now let's think about risk premiums. Risk premiums are really the heart of finance. Let's start by looking at our basic price is expected discounted payoff formula. And I want to break this up. One of the central tricks, I'm going to break E of mx up using the definition of covariance. This is just the definition of covariance is E of mx minus EMEX. So I can turn that around and break it up this way. We know what E of m is. That's just the risk-free rate. So now we've broken up the price into two components. The first, E of x of RF, and the second, covariance of M and X. This is a beautiful formula. E of x over RF is just the standard discounted cash flow formula. Take the expected payment, discount it by the risk-free rate. Wait, you say, that's wrong because it doesn't include corrections for risk. That's exactly right. We now have broken it down into the time element, captured by interest rates, and the risk element, which is generated by the covariance of the discount factor with the payoff. The covariance is what determines the risk premium. That's the central lesson here. Let's express that in terms of rate of returns, which is more traditional in the finance and in the empirical literature that we want to connect to. So we can break up any return into the risk-free rate and then the return minus the risk-free rate, or the risk-free rate plus the excess return. And again, the risk-free rate captures the time element, and the excess return, which is a zero-cost portfolio, captures the risk element. So starting with our basic equation for pricing and excess return, let's break it up similarly into the product and the covariances. That's just E of excess return over risk-free rate plus the covariance. And now turn it around, put the expected return on the left. That's the tradition in finance. Let's, instead of trying to understand prices, let's understand expected returns. It's the same idea, of course. A low price, if that's time and that's price, a low price is the same as a high expected return. So it's the same idea. So what do we learn? Expected returns are equal to the covariance of the discount factor with the returns. Or the original return is the risk-free rate plus the covariance of the discount factor with returns. We're almost ready to do what we just did with interest rates. We're almost ready to plug in M for consumption growth and start learning about the macroeconomic determinants of risk premiums. Where do they really come from? Why do some securities pay higher average returns than others? That was the exciting question we started the whole class with. But if we plug M in here, again, we've got this thing with the nonlinear consumption growth to some power, and then we start doing approximations. Perhaps, again, by going to continuous time, the continuous time limit will be linear and simple for us. And that's exactly the way it is. So we've learned that covariance drives the risk premium, not the variance of the return. The low price is what generates a high expected return. So these two ideas are similar. And risk premiums are really important. If we look at just the stock market in general, the stock market's average returns about 8%, of which 2% is risk-free rate and about 6% is risk premium. So the risk premium is central to understanding stock market returns and everything in economics and finance. Okay, to continuous time. How do we do that? Let's go back to that into by Ito's lemma, d lambda, dv, and the cross product. And now we know what to do with each of these three terms. E of d lambda over lambda is the risk-free rate term. E of dv over v is the expected return. That's the kind of object we're looking for. That's good. And now we have that term, which is the covariance of discount factor growth with return. So let's plug this thing out on the left-hand side. Expected return is risk-free rate minus covariance of discount factor growth with return. That is, now you can see an equation that is transparently in continuous time exactly the same form as the one in discrete time. E of d lambda v didn't look a lot like 1 equals E of mr, but expected return is risk-free rate plus covariance with discount factor. That is a clear expression in continuous time of the same discrete time idea. And fortunately, we lose that RF in front, which was kind of annoying in the discrete time case. So now we're ready. What have we done? We've thought about risk premiums expressed as expected returns in continuous time and discrete time. And now we're ready to put consumption in and start thinking about the macroeconomic determinants. Where do risk premiums really come from? So we've got expected excess return is risk-free rate plus, and now d lambda over lambda was just the only term that remains is the Ito term. The only term that remains is the one where the shock to consumption growth hits the shock to return. So all that remains is expected return is risk-free rate plus covariance of consumption growth with return multiplied by the risk aversion coefficient. Or the discrete time approximation we were looking for, expected return is risk-free rate plus covariance of consumption growth with return multiplied by risk aversion coefficient. This is just a beautiful formula and the heart of all of finance. What do we learn? First, the ingredient. Investors care about consumption. They don't care about the return of the securities. They don't care about the portfolio return. They don't care about the stocks they hold. They care about consumption. So why is it that covariance rather than variance of return is what drives the risk premium? Because the covariance of a return with consumption growth tells you how much does buying a little bit more of that asset affect the volatility of your consumption growth. And that's what you really care about. You don't care about the asset per se, you care about the consumption growth. If you were asked, do you want a steak? We have to ask in the context of what overall dinner? That's what's going on here. If you're asked, do you want some of this return in the context of what does it do to your overall consumption growth? As an example, a good example, you might well buy securities with terrible expected returns. You are. If you have car insurance, you have a security with a terrible expected return. Why do you hold a security with terrible expected return? You're paying them more than they pay you. Because they pay you on days when your car just got stolen. They pay out very well. Their payment is very good. It's negatively correlated with consumption growth. They pay well on a day when your consumption is terrible because your car just got stolen. Conversely, most securities pay well when you're already doing well, and that's why you require a high risk premium to be forced to hold it. Let me show you just a simple example to drive home why covariance matters. Consider two securities. The security has payoff X or excess return, if you'd like, X or RE, doesn't matter which we call here, which is either +1 or -1. And the probability is a half of +1 or -1. Well, there's security A and here's security B. They both have, that has +1 and -1, this has -1 and +1. Do you care which one you own? From what I've told you now, they look identical, right? Who cares which state the plus and -1 is? But now let's suppose that this security is in a state where consumption is good and that's consumption is bad. Whereas this again is consumption is good and that's consumption is bad. Now compare the two securities. This one gives you more money when you're already feeling great and takes money away when you're feeling terrible. This one gives you money when you're feeling terrible and takes money away when you're feeling great. This is a much better security for you to buy. That means, however, you will drive its price up and you will drive its expected return down. So the expected return will be low on this security because of its covariance with consumption growth, having nothing to do with its variance or other properties. So next, let's think about risk premiums and betas. Where we were is we had expressed expected returns, the risk premium, in terms of a covariance with the discount factor.
Okay, so far we learned risk premium risk premium related to the consumption. Risk. Okay, so consumption belongs to macro economy. Okay, risk. And so the risk, you can imagine the risk as arising from the system. Okay, system risk. Here, system risk means the size of financial distress market risk illiquidity. Okay, so system risk. This is concessional risk. Yeah. Okay. So the next video we mainly focusing on the betas. Betas, which is called system, which is called system risk, determined by some factors. Yeah. So like determined by the interest rates, determined by the unemployment rates, determined by the inflation rate. Okay, so or exchange rate, or the size, financial distress, the market risk, and the year liquidity. Okay, something like that. Okay, so as you see the video, the first here, betas. Okay, so betas. Okay, not only one beta. Okay, so betas. Okay, multiple betas. Okay, so let's go start with this video.
So next, let's think about risk premiums and betas. Where we were is we had expressed expected returns, the risk premium, in terms of a covariance with the discount factor or in terms of a covariance with consumption growth. I emphasize that covariance, not the variance of the return, matter. It's more traditional in finance to express expected returns in models with regression betas on the right-hand side. And it's easy enough to get to that representation. Let's just take that covariance of M with the return and multiply and divide by the variance of the discount factor. Or with consumption growth, let's multiply and divide by the variance of the consumption growth. Put all the other stuff in parentheses over here. And then covariance divided by variance is a regression coefficient. It is by definition a beta. So we write the same model as expected return is proportional to beta times a parameter known as the market price of risk. These are called market prices of risk. I've added an I here to emphasize the point is to distinguish why some assets are different from others. So I is different from J. Why is asset I different from asset J? Why do value stocks pay more than growth stocks according to this model? Because asset I has a different beta than asset J. They all share the common lambda. So the beta, the covariance, is the thing that makes one asset different from another. This notation suggests the common procedure. How would you go about checking a model like this? How would you use a model like this? Well, you could do it in two steps. To evaluate the covariance, your first step is you run a time series regression. You run over time the return on an individual asset on a constant on consumption growth. I'm doing my second model. And this regression is run over time for each individual asset. The point of that regression is to find the beta coefficient, the tendency of this asset to fall in times when consumption falls. Then that's an input to the model. The model says expected returns should be high where betas are high, and the lambda, the market price of risk, is the slope coefficient relating expected returns to betas. Alpha is what is the word Greek letter we use to talk about deviations from the model. So I put it in parentheses. It shouldn't be there, but if it is there, we call alpha the deviations. It's the expected return over and above compensation for risk generated by the model. So graphically, the standard picture of asset pricing looks like this. This is what the world should look like. If you took all securities and lined them up by their betas, some securities, like interest rates, they're constant, they don't have any beta. Other securities, when consumption growth goes up and down, they have whatever betas they have, but their expected return should line up with their betas. The ones with higher tendency to fall in bad times have to pay their investors higher expected returns to get those investors to hold them. Lambda is the slope coefficient in this relationship. When you get a higher beta, that tells you how much more expected return you have to pay. And alpha is what we call the deviation from the relationship. Here's an asset with alpha. It's giving its investors higher expected returns than the compensation for risk that they should need to get. So just multiplying and dividing gets us to the standard expected return beta style of model. This is the consumption capital asset pricing model. Now, a few comments on this model. First of all, the notation is traditional, but watch out here. Expected return is the thing we're trying to explain, and beta is the right-hand variable. We're used to beta being slope coefficients, but no, in this cross-section relationship, beta is like the x, expected return is like the y, and lambda is like the slope coefficient. Beta is the thing we're using to explain expected returns. Another way of seeing the difference, lambda, the market price of risk, is the same for everybody. Right? There's no I in here. There's no I in there. Beta is the thing that's different from one asset for another. This relationship, usually market prices of risk are just taken as free parameters. That's kind of cheating, because this shows us that a model tells us what the market prices of risk should be. The market price of risk is higher if you live in a risky economy, or if the risk aversion is higher. Naturally, if it's either riskier or higher risk aversion, it's going to take more expected return to induce investors to hold those assets that are risky in terms of high beta. The I notation emphasizes most of the common ways of misunderstanding this. What is this about? What is this statement trying to tell us? It's about why some securities have higher returns on average than other securities. Why did the value stocks for Fama French have higher returns on average than the growth stocks? It's not about why returns vary over time. Why is there this crazy volatility of returns? That we can address. That's not what this model is trying to talk about. It's not about why did IBM go up yesterday. It's about the expected return over long periods of time. And it's not about which is going to go up tomorrow. We're not trying to predict stock returns over time. We're trying to understand why long-term average returns are higher on some securities than other securities. That's what the E part means here. Again, I emphasize it over and over again. It's one of the classic theories of finance. What does this tell us? It tells us that the variance of the return does not matter. What matters is the beta, the tendency of the return to fall in bad times as measured by consumption growth. Another way of saying that same classic proposition of finance is that only systematic risk is priced. What do those words mean? Well, think of running a regression of the return on the discount factor or consumption growth and a residual. That breaks apart the volatility of this return into two components. The volatility of the return is the component correlated with the discount factor or with consumption growth, and an idiosyncratic component. Since those are regression, those two things are uncorrelated with each other. So variance of return, it doesn't matter. Variance of return, you can break it apart into two components. The systematic component, this varies with the discount factor, and the idiosyncratic or diversifiable component. Another way of saying covariance is what matters is that only the systematic component of risk matters. The idiosyncratic component of risk does not matter. Only the part perfectly correlated with them generates a risk premium. You've seen here a first example of what we mean by an asset pricing model. We have a general theory in terms of a discount factor, but to make it operational, to know what to run regressions on, we need something to translate, to connect the discount factor to real data. What I've done here is I've used a utility function to connect the discount factor to consumption growth, so we run regressions on consumption growth. Where we're going is other kinds of asset pricing models, which will work the same way, we'll use other theoretical ideas to connect the discount factor to other kinds of data. Fama and French's paper connected the discount factor to the returns on a value portfolio, a small portfolio, and so forth. Well, we'll have to think about that, but this shows you the logic of an expected return beta asset pricing model and shows you where these classic propositions about the nature of risk and risk premiums in the theory of finance come from.